Welcome to The Economy Magazine at I-24 News, where we take a look at the world markets and the global economy. I'm Natalie Ehrlich. Well, coming up today, the U.S. Federal Reserve sparking a major market rally across the globe. Stocks in Asia, Europe, and the U.S. enjoying a nice lift here, and we bring you analysis. Sam Chester of Clarity Capital joins us from New York. And Idan Uzilai, Chief Investment Officer at Epsilon Investment House, joining us here at the Jaffa Port just later on the set. Now let's start with the headlines. Global markets rallied just following the U.S. Federal Reserve's first rate hike since 2006. Japan's Nikkei climbed almost 1.6%. China's Shanghai Composite jumped 1.8%. And the Hang Seng advanced almost 0.8% higher. Well, European stocks also enjoyed a nice lift, with the German DAX up 3.4%, London's FTSE higher 1.5%, and the French CAC also 2.5% to the upside by the afternoon. Well, U.S. Dow futures also signaled a strong open. Well, in an effort now to add new life to Argentina's economy, Buenos Aires announced it is lifting its currency controls. New President Mauricio Macri is an advocate of the free market and has promised, as part of his election campaign, to allow the peso to weaken in order to boost exports and stimulate growth. The previous administration had instated that capital restrictions to protect the country's low foreign reserves. On Wednesday, Macri's finance minister shared a message of change and market freedom.
Those who want to export will be able to export without asking permission. Those who want to import can import without permission. Those who want to buy dollars can buy dollars. Those who want to sell dollars, no one is going to go after them. This is how a normal economy functions.
Meanwhile, in the United States, both Democrats and Republicans hinted that the 40-year ban on U.S. oil exports could be lifted. Now, according to the White House, oil products are already shipped abroad through various waivers, as much as 500,000 barrels of oil a day through these exceptions. Well, U.S. House Speaker and Republican leader Paul Ryan highlighted that the lifting of the ban would be positive for the U.S. economy as well. Analysts view this change most harmful to the oil cartel OPEC, adding that the removal would be a game changer, at least in the long term.
One reason that we're not overly concerned with the substance of the lifting of the oil export ban is that the United States already exports 4.3 million barrels a day of refined petroleum product.
Ending the 40-year ban on oil exports, do you know what that does for our foreign policy, what that does for job creators, what that does for infrastructure? It's huge. It's permanent policy that's good for American foreign policy, good for energy, good for jobs, for temporary measures. I think that's very, very good.
Ukraine's Prime Minister Arseniy Yatsenyuk said Wednesday that Kiev will suspend trade with Crimea in 30 days. Last year, Russia annexed Crimea, which has since suffered blackouts after 4 pylons supplying power to the peninsula were blown up back in November. The announcement signals even worsening relations between Ukraine and Russia.
All supply of work, goods, and services from the temporarily occupied territory of Crimea to the other territory of Ukraine are banned, except for personal belongings of citizens, socially important foods, and humanitarian assistance.
The head of the UN's nuclear watchdog said Wednesday that Iran's goal of having sanctions lifted against it by the end of January are, quote, not impossible. Iran's President Hassan Rouhani indicated Wednesday as well that he hopes that these sanctions would be lifted in January. The International Atomic Energy Agency, whose duty is to verify that Tehran has fulfilled its part in the bargain which world leaders reached earlier in the year, indicated that the deadline could be met. Now, these restrictions Iran must put in place include drastically reducing the number of centrifuges installed at its underground enrichment sites, removing the core vessel of a reactor at Arak, and shrinking its stockpile of enriched uranium. And the Fed's decision to raise rates after several months of delay sparked a major worldwide rally. Here's more.
The United States Federal Reserve's chair, Janet Yellen, announced on Wednesday that the interest rate would see a slight increase from near 0% to between 0.25% and 0.50%. It is the first such rate hike in nearly a decade and a signal that the Fed believes that the worst has been seen of the 2008 financial crisis.
This action marks the end of an extraordinary 7-year period during which the federal funds rate was held near zero to support the recovery of the economy from the worst financial crisis and recession since the Great Depression. It also recognizes the considerable progress that has been made toward restoring jobs, raising incomes, and easing the economic hardship of millions of Americans. And it reflects the committee's confidence that the economy will continue to strengthen.
Indeed, the news seems fit for expected growth of 2.4% and unemployment falling below 5% next year. At the same time, some economists, such as Paul Krugman, suggest that while wages are up, they are not up enough compared to pre-crisis levels, and inflation has not yet reached its target of 2%. And there is caution across the board. Yellen noted clearly how small an increase this is.
I think it's important not to overblow the significance of this first move. It's only 25 basis points. Monetary policy remains accommodative. We have indicated that we will be watching what happens very carefully in the economy in terms of our actual and forecast, our projected conditions relative to our employment and inflation goals.
Raising the interest rate in general curbs borrowing and, in turn, spending. But this was an anticipated move, and most onlookers expect impacts to be tempered.
Given that they've been talking about this possibility now for, maybe at least 6 months, the markets, I think, would have been confused if they hadn't taken the action they took today.
This rate hike will be the first in what will likely be a series to come next year, rising to just below 1.5% over the next 12 months. The immediate market impact saw U.S. and Asian stocks jump at the news, taking up the idea that this hike signifies underlying confidence in the U.S. economy going forward.
For further insight, we are now joined via Skype by Sam Chester of Clarity Capital, who joins us from New York. Thank you very much for being with us, Sam.
It's a pleasure.
Well, look, how did the U.S. markets react to this decision so far?
Well, U.S. markets really led the way in a favorable reaction. I mean, initially, after the rate was announced around 2 p.m. yesterday, the average of the Dow, it rose and it closed all the way at 1.3%, and S&P 500 followed a very similar trajectory, and it closed even a little bit higher at 1.45%. So U.S. markets responded very favorably, which isn't something necessarily that you always see in response to hikes by the Fed.
Does that mean that the markets already priced this decision into the markets?
Part of that. I mean, I think that with so much discussion going on for most of 2015 on when the rate hike would finally happen, markets had long since priced it in, and that's part of it. But in particular, the reason why there was really a positive impression is that the decision by the Fed was really seen as a show of confidence in how the U.S. and the global economy are performing. And that show of confidence and that reality of strong growth numbers across the board is something that then markets are responding to as well. And the other element is that financial systems, of course, are very opposed in many ways to equivocation. The last several months of will the Fed raise it, won't the Fed raise it, when will they make it, that makes investment very difficult, since ultimately the people making the investment decisions are human. And therefore, firm decisions like this, including the call by Fed Chairwoman Janet Yellen yesterday, that in the next year there will be several further rate hikes, those sorts of clear communications and schedules encourage markets to respond favorably.
All right. So it seems like the markets got that confidence and clarity that they were hoping to get. How many more rate hikes can we expect in this next year?
So Janet Yellen didn't give a direct answer to that, but the sense is that the Fed will raise the interest rate by about 1% in 2016, and that they would do so, therefore, in four separate hikes. So each time we'd see it go up by about a quarter. And so what that means in part is that already you're seeing market observers the morning after here in New York are quickly saying, okay, when will the next hike actually take place? And will it take place earlier? And already you see people making investments based upon the fact that perhaps the hike next year will be even higher than 1% net. So even with the previous comment that the market on the whole is responding favorably to sort of clear communication from the Fed. At the same time, already the discussion has moved to what will be the next step and when will it take place.
All right. Well, what's your last word here?
Well, one of the major concerns from the Fed isn't just the U.S. markets, which is what we see here in New York, but is globally, particularly in emerging markets. Emerging markets are very vulnerable to the U.S. Fed rate since they've been borrowing so much in recent years. And that's something that really observers should pay attention to with all the concerns that we've been seeing in emerging markets in 2015 and looking forward to 2016 as well. There's a lot to keep our attention, and we'll be doing so very closely here at Clarity Capital.
Well, thanks, Zephyr. Sam Chester, very much appreciate it.
Great. Thank you.
In studio now for another perspective, we are joined by Idan Azoulay, Chief Investment Officer at Epsilon Investment House, to discuss this Fed rate hike. Thank you very much for being with us, Idan. Well, let's talk about here. What does this signal about the health of the U.S. economy?
Actually, this hike is coming at a time when the U.S. economy is actually showing some weakness. You see it from the GDP that its pace is actually going down. You see the inflation hasn't reached even the target that the Fed had set a few years ago. So I think it's coming not in an ideal time, if you can say ideal time for a rate hike. And I don't think this is changing very much in the very near future.
Right. Well, we did have some analysts and also Nobel laureate Paul Krugman here saying that this was not the right time to raise this interest rate, that it was, in fact, premature because there's still weakness in the labor market, for example, right?
Basically, I agree with that. If you compare the current hike with previous episodes of rate hikes, you'll see there's a major difference in the sense of economic growth, of inflation, and even employment. At previous hikes, you see a much more healthier economy than now. So I don't think, as I said before, I don't think this is an ideal environment for rate hikes. But in another side of the story is that the Fed had to raise rates because it actually was talking about it throughout the year. And if it hadn't raised rates now, I think that the market will lose trust in the Fed.
Right. And you mentioned this here. We saw the markets really rally today pretty much across the board all over the world, in Europe and Asia. And now the U.S. also poised for a strong open here. So what does this signal about the health of the global economy? Does it signal anything?
I think it's premature. And I think we should look at the bond markets because you expect that when rates are going up, that the bond yields will go up as well. But actually, you see the opposite reaction. You see yields are going down. And then you wonder to yourself, how is that possible? This is not according to the books. So I think that the market has priced it already. And now we look forward. And if we look forward, we see actually weakening global economy. And I think that the market will start to show a little bit of worry about global economic growth.
Right. Well, perhaps is the U.S. going to be a bright spot in this worsening global economy?
Although it is a bright spot, especially if you look amongst the group of developing economies, you know, I want to go back to Larry Summers, who actually coined the term secular stagnation. And I think that, in a sense, we are in that state because even though U.S. has recovered quite nicely from the crisis, we still see economic growth going up below long-term average. So I think it's still, even though it is growing more than Europe, it's still in a low growth economy, and as you can see, also low inflation, and therefore, though it is a bright spot, still it's not what it used to be before the crisis.
Interesting point here. Well, what about Israel? How is it going to react, and how is it reacting to this rate hike?
Actually, Israel is I think it is diverging from the U.S. in the sense that in the U.S. you see a strengthening economy, whereas here in Israel we can see a weakening economy. You can see it on the GDP that is actually, its pace is going down. You see inflation. We are in the second year of deflation in Israel. So if you wonder whether we'll have any effect on interest rates here, I don't think we will. I think we'll see diverging paces of interest rates, whereas in America, probably rates will keep on going up, and in Israel, we'll probably see them very flat in the very near future.
All right. Well, thank you very much for bringing this insight to us from all over the world, and also your perspective on Israel itself. Do very much appreciate it here at I-24 News. Now, that wraps up our show today. Do stay tuned here every day for all your global economic news. I'm Natalie Ehrlich from the Jaffa Port in Tel Aviv. Thank you very much for watching.